Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in today's video, we'll be taking a look at the trade desk and why it deserves a position in your portfolio because of its attractive long-term growth story. But before we get started, don't forget to hit the subscribe button if you're new to the channel to get more stock market content just like this. The trade desk went public on September 21st, 2016 and has since been listed on the Nasdaq with ticker symbol TTD Tango Tango Delta. It began trading with an initial price of $18 per share, but it proceeded to close at around $30 on the first day of trading, up 67% in just that single session. The huge leap was clearly indicative of things to come, as in the almost 4 years since, the stock has already increased 20-fold, now at a current price of roughly $355 as of recording on June 6, 2020, and a total market cap at around $16 billion. To put that level of increase in perspective, if you were fortunate enough to have bought $50,000 worth of TTD at the IPO price, you would have already parlayed that into a whopping $1 million, while investing in an index fund like the Vanguard VOO during the same time span would have yielded only about $70,000. For the majority of us less fortunate and not in that position, I still believe there is a huge opportunity to reap a large windfall in the coming years, as this company is still very young relatively speaking and is still a long way from hitting its growth plateau or its full potential. I will break down my bullish thesis in this video, but first let's go over what the trade desk does and how they as a company fit into the bigger picture to make sure we do our due diligence and understand the value proposition. So the trade desk is one of the leading demand side platforms, or DSPs, in the marketing/advertising industry globally, with a pure focus on digital channels. DSPs represent companies who wish to purchase ad space to raise awareness of their products or services and negotiate with counterparts on the sell side platforms who hold inventory space through an auction known as real-time bidding. What makes TTD stand out from a lot of its peers in the industry, however, is its ability to compete in a multitude of channels to best serve its customers, including but not limited to display, social media, mobile, and video advertising. Let's take a quick look at these different channels to get a better idea of what each entails. Display ads are the rectangular containers found embedded in nearly every monetized page on the internet that unfortunately many people use ad blockers against. Nonetheless, they can be static images or videos and are often highly targeted through a combination of cookie and account data. Display ads are also prevalent throughout social media channels such as Instagram and Twitter, but can be even more targeted with higher granularity because the platform knows the user's interests plus who they follow and communicate with. It occupies a large slice of ad revenue in today's world simply due to the amount of time people are spending on these platforms collectively. The mobile segment is also rather dominant, broadly speaking, due to the amount of hours people spend on their phones in general when not just on social media. This segment includes everything from search engine results and suggested application downloads to everything in between, including the notorious quote-unquote free application that forces users to instead watch short ads, which I'm sure we've all encountered. It is easy to discern the interests of users in the case of search queries, but even within applications and redirects, because of the context of how users arrive there, certain aspects can be extrapolated. The next two channels are arguably the fastest growing segments in digital advertising today. The first is video, specifically connected TV, or CTV for short, where advertisers can purchase space to reach the millions of consumers streaming popular services such as Netflix, Hulu, Roku, and HBO directly, especially in an age where traditional TV and cable TV are taking a nosedive in demand and usage. Ad targeting is largely based on what kinds of shows and programs a user is known to watch. The last segment is audio through known platforms such as Pandora and Spotify, but also immensely popular podcasting networks. According to Midroll, podcast advertising can run anywhere between $18 to $50 per 1,000 listeners, and with the growing number of consumers in this market, including listeners of very popular shows such as This American Life and The Joe Rogan Experience, it's no wonder that companies are becoming increasingly interested in advertising in this popular and sought-after avenue. In most cases, it is easy to discern the type of demographic listening to a particular podcast or music, which can thus be leveraged by advertisers for maximum effectiveness. The trade desk is able to reach all of the aforementioned channels because of its patented platform and algorithm known as KOA, spelt KOA, its secret sauce if you will, which establishes a plausible economic moat. The concept of the moat, if you recall, is often used by Buffett and other fundamental analysts to determine if a company can withstand and overcome its competitors. Furthermore, TTD operates under an emerging method taking over the digital advertising industry as a whole, known as programmatic advertising. In a nutshell, programmatic advertising is a process of automatically purchasing digital advertising space without the need for humans to be involved. The end-to-end process takes a mere 1/10 of a second to complete according to TTD, and because the underlying algorithms can target audiences much more deterministically based on some of the uniquely identified elements previously mentioned, affords a much more streamlined process for advertisers. Before the emergence of programmatic advertising, it was difficult to access ad inventory on the supply side due to the lack of visibility, and in some cases, up to 60% of a publisher's ad space went unsold. Add to the fact that ad rates are quoted dynamically by the algorithm via real-time bidding, which completely eliminates the need to negotiate and haggle over going ad rates. This gives DSPs like TTD tremendous power and leverage in an age where data and precision are driving ad spending. For advertisers, the benefits of using a DSP focused on programmatic advertising obviously includes all of the aforementioned, but not to be overlooked is the fact that DSPs are independent of specific platforms such as Google and Facebook. DSPs are mostly agnostic to where they ultimately end up buying ad space, since they don't actually own any underlying platforms or have any specific loyalties, so long as it best fulfills their customers' channel and cost criteria. This means a player such as TTD effectively becomes a one-stop shop for all an advertiser's needs and can do full spectrum fulfillment from a single source, which makes them extremely attractive to companies looking to not only target the big walled gardens of Google and Facebook with access to huge user bases, but also additional channels such as podcasting and CTV if they wish to augment their exposure. And by the way, since we mentioned Google and Facebook, it's not really possible to have an intelligent discussion about digital advertising without bringing up these two titans, given their absolute dominance in the space. In fact, most experts refer to it as the digital advertising duopoly. This table shows the total digital ad revenues worldwide from 2019 and projected onwards to 2022, broken down by company, and clearly illuminates how the two Silicon Valley giants have already taken a staggering 53% share of global digital advertising here today in 2020, but is even projected to increase to over 55% by 2022. While this might look like doom and gloom for smaller competitors like TTD on the surface, it's actually the opposite if we take a closer look at the numbers. The first takeaway is that the total digital ad spending worldwide is clearly trending upwards, projected to be over $460 billion by 2022, as all players look for a bigger slice of the pie, regardless of their size. If you look carefully, all the players on this list are actually projected to see an organic rise in ad revenue. The other takeaway is that there is still a significant chunk of the market not controlled by Google, Facebook, or any other of the large companies in this list for that matter. In fact, roughly 20% of the market, which represents the perfect opportunity for TTD to capitalize, since again, they aren't tied to any particular platform. So while the largest players in digital advertising will retain control of the lion's share as we progress into the future, TTD is in a great position to leverage all of them if needed, and even beyond to other avenues they can't reach. If we shift gears for a moment and take a look at digital ad spending versus total media ad spending globally, which includes traditional media channels such as print and broadcast television, we can see a clear trend of digital advertising gradually wrestling away non-digital ad spending dollars. In 2020, where we are today, worldwide digital ad spending has grown over 15% year over year and represents nearly 54% of all ad spending globally. By the year 2023, however, the projection is that digital advertising will comprise 60.5% of total media ad spending, topping a staggering $500 billion. Once again, it appears that the trade desk is perfectly positioned to take advantage of this once-in-a-lifetime shift as companies currently relying on traditional media look to enter the digital space. Now shifting focus once again, this time to just programmatic advertising as a subsegment of digital advertising, where TTD holds a competitive advantage over other players in the DSP segment with the aforementioned KOA algorithm, which can run 9 million queries per second to better match target audiences and improve results. We can see that it too is projected to rise to over $147 billion by 2021. Programmatic advertising already represents 69.2% of all digital ad spending worldwide, but by next year, that figure is expected to jump to 72% and is clearly one of the fastest growing segments in the digital ad market. All the data to this point tells us there's an undeniable upward trend in digital ad spending globally, an obvious shift from traditional media spend to pure digital, and last but not least, a substantial movement towards programmatic within digital advertising. The real question then that some investors might be asking is how much does the trade desk and other DSPs actually collect in all this spending? In a recent study by the Incorporated Society of British Advertisers on the transparency of the supply chain, in which TTD was an active participant, it was found that approximately 8% of advertiser spending went into the pockets of DSPs, with the remaining 92% divided amongst the other participants. A quick calculation tells us that by 2023, the $517 billion total digital advertising worldwide spend, which we saw earlier, results in a total addressable market of over $41 billion just for DSPs. As mentioned earlier, CTV alongside audio represents one of the fastest growing segments for TTD, so I wanted to dive into this topic for a moment. Despite CTV advertising growing to a whopping $7 billion in 2019, representing about 3% of all US ad spending, it isn't very significant currently. However, with the launch of Disney Plus and upcoming services such as HBO Max and Comcast Peacock entering the fray, to go with already existing players like Amazon, Apple, Roku, and of course Netflix, the streaming space is certainly becoming a battlefield for supremacy. The increase in consumer demand translates to CTV ad spending expected to double over $14 billion by 2023, and just like we have seen with the shift from traditional ad spending to digital, it appears consumers are also cutting the cord on traditional TV and are moving to the cloud for their video. While the big players currently operate ad-free and charge an ongoing subscription fee to create revenue, it is expected by many analysts that some big players, such as Netflix, will introduce an element of advertising in the near future as consumers show fatigue towards high subscriptions. During a Q3 earnings call in 2019, CEO Jeff Green stated, "I believe they'll eventually adopt what others have, giving consumers the choice to pay more and avoid all ads or pay less and see a few highly relevant ads," referring to services such as YouTube Premium. As another example, recall that as recently as 2014, Netflix's subscription price was $7.99, but that has since increased to $8.99 for the basic plan, and there exists even higher amounts up to $15.99 for the premium offerings, which allow multiple devices and HD resolution. In fact, TTD sees such huge potential from CTV that they have made CTV their number one priority in 2020, opting to invest large percentages of their free cash flow into integrations with the numerous partners in the streaming space. Just like we have seen with the business opportunity increase for TTD in digital ad expenditure at large, by investing in interoperability across the board towards all CTV players, there should be no doubt that they will be rewarded in the future if/when CTV demand rises, especially as they continue to get ahead of competitive DSPs who have yet to mobilize in the streaming war arms race. Another aspect of TTD which really gives it a serious edge when compared to other DSPs or even the duopoly of tech giants Google and Facebook is its exposure to the Chinese market. Due to censorship and information control by the CCP, many US services firms have little or no presence in the world's most populated country, considered by many as one of the greatest revenue sources, taking a look at Apple and Tesla for example. The trade desk has formed strategic alliances with some of the largest platforms and companies in the region, such as iQIYI and Youku, owned by Baidu and Alibaba respectively, and even Tencent to help global companies reach a potential audience of almost 1.5 billion individuals. In fact, TTD went so far as to double down on this foray into Asia by announcing only a couple months ago that it had partnered with Chinese social media company TikTok, which ranks as one of the most downloaded apps in the entire world within the last decade and is now seeing a whopping 800 million monthly active users. In 2019, in just the US alone, there were close to 50 million downloads of the app, and while time will ultimately tell, it does appear on the surface that the app is growing in popularity and is becoming a distinct alternative to established players like Instagram and Snapchat, and therefore a viable advertising platform. Before diving into the financials, it is also worth quickly noting that TTD has made significant effort to not transact with identifiable consumer data despite its intelligent targeting algos, since as we saw earlier, one of its prime directives is to remain neutral and agnostic to the final destination of its customers' advertising dollars. This potentially shields it from any regulatory or antitrust scrutiny in the future, as other companies like Google, Facebook, and Amazon come under fire in the wake of recent events such as Cambridge Analytica and breach of the EU's GDPR laws. In another recent interview, CEO Jeff Green stated, "Because the trade desk does not transact directly identifiable consumer data, and because we don't own a search engine, we provide a unified open ID that enables advertisers to compare every destination on their media plan to every other destination objectively. Our data and the data of our third-party partners cannot be directly associated with an individual. While legal proceedings of this nature shouldn't be taken by investors as positive or negative for the moment, it is certainly a thread worth monitoring." Finally, we arrive at the company's financials. The first thing to notice is the huge year-over-year increase in revenue from 16 to 17, 17 to 18, and finally 18 to 2019, coming in at 52%, 55%, and 39% respectively. For a long-term growth prospect such as TTD, these are the sorts of numbers that investors should look for and hope that the company can continue at the same clip for years to come. Obviously, given what we have already examined with the state of the digital advertising landscape, the growth in CTV and its investment into the Asian market, investors should feel pretty confident that this is indeed the case, with no obvious signs on the horizon for reasons to be concerned on the growth front. What's also impressive from the income statement is that for a company only 4 years removed from its IPO, it started generating positive EPS 3 years ago. The EPS growth, in fact, led us to the end of Q4 2019, when the company reported a yearly profit of over $100 million. If we consider for a moment that its total revenue for 2019 was only $661 million, when juxtaposed alongside the 2023 projection, where digital ad spending exceeds $517 billion, of which DSPs take an 8% cut, then there appears that there is still plenty of room to grow, as the current figure represents approximately 1.6% of the total addressable market. It remains to be seen how much of the market that TTD will be able to wrestle away from competitors, but given everything we've seen about TTD thus far, it would be hard not to imagine it could be orders of magnitudes more in the future. Sliding over to the balance sheet, we see that the company has slowly added to its cash reserves over the years, especially important in the current pandemic and the resulting economic conditions where marketing spending in general has and will take a short-term hit. TTD doesn't appear to be overloaded with debt at all, with a quick ratio above 1 and extremely manageable long-term liabilities that can be easily met with its total assets. While not an amazing balance sheet by any stretch of the imagination, such as we might see with Google or Facebook, it's certainly not terrible, and there doesn't appear to be anything to be concerned about here. Overall, management appears to be doing a solid job. Another telling factor is to examine the underlying stockholders. While not a bulletproof indicator by any means, it is often handy to know who they are in order to gauge a stock's reliability and the market's overall belief in its current and future performance. As we can see, 80% of all outstanding stock are held by institutions, suggesting there is strong belief in TTD at the highest level of investor and not a lot of rampant speculation. In fact, 530 institutions, and a lot of A-grade ones in that, including Vanguard, Morgan Stanley, BlackRock, and JP Morgan Chase, have all bought in. One other thing worth looking at is the amount held by company management, directors, and staff, which appears to be only a meager 2%. Ideally, we would like to see a much higher figure, which helps to align management and solve the age-old agency problem, but we do know from SEC filings, however, that CEO Jeff Green has a position of well over 200,000 shares, so at least there is alignment there. For the sake of completeness, we should also take a look at the PE and sales ratios, but I'm generally of the opinion that for high growth companies like TTD, these should be taken with a grain of salt, especially trailing PE, since investors are willing to pay a premium for the potential of a company regardless of these values. Prime examples are Amazon and Tesla, who have always traded at lofty ratios throughout their respective histories. But as we can see here, the forward PE is currently at 75 when compared to the advertising sector average, which is generally in the 30s. The price to sales value of 22 is also significantly higher than the sector average of about 1.5. Again, while these might not scream value to investors, they are only one aspect to be considered in the bigger picture. The final point we'll look at is the expected growth for 2020 and 2021. Given the state of the world economy and the health issues we're experiencing, it's not surprising to see a projected slowdown to only 5% for the current year, but analysts foresee a return to a healthy 34.2% in 2021, which is close to the growth we saw between 2018 to 2019. There's no reason TTD can't grow significantly more than this figure, especially if the trade desk investment in CTV pays off and programmatic advertising takes another leap forward. So given the entire cross-section of everything we've covered, despite some small concerns about the high ratios, The total addressable market potential for the trade desk in the expanding world of digital advertising, coupled with the compelling qualitative and fundamental growth drivers, there are more than enough reasons for me to believe that this stock has a place in any investor's portfolio, especially as a long-term growth buy and hold. That about wraps it up for this video. What are your thoughts on the trade desk? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you found this video helpful or insightful, and of course subscribe to really support the channel. Before I go, click on any of these 4 videos for some other thoughts on the stock market, especially the one in the top left where I talk about another great growth company in Alteryx. As always, thanks for watching, and I'll see you in the next one.